The price of crude oil is one of the most important correlations to Forex pairs there is. So understanding what price changes in crude oil due to Forex pairs you are trading is fundamental to a profitable trading career. In the following video I will show you all important correlations in a clear cheat sheet, and I will also explain the reasoning behind them so that you can understand them fully for yourself too. So right here is the cheat sheet I created for this video and for you. So if you want, you can make a screenshot of this right now, or you can pause the video to see whether you already understand some of the correlations you are seeing right here. And at the end of the video, I will return to this cheat sheet and actually explain all of these correlations you see individually as well. So first of all, I wanted to explain a little bit about where correlations between currency pairs or Forex pairs actually come from in the first place. So right here you can see a small list of some of the biggest crude oil producing countries. And as you can already guess, these countries' currencies are very correlated with oil. Because when the price of oil decreases, these countries will get a lot less paid for their produced oil, and therefore their currencies will decrease in value. Although this list does give some clarity, it is far more important to look at the relative value of crude oil export to the GDP, the gross domestic product, for example. A country like Canada has a way more diversified export than Russia or Iraq, which means that a decrease in price of crude oil is more devastating for Iraq than for Canada or the United States. So this is one of the main reasons why oil is correlated with currency, but there's actually more. So first of all, it is needed to know that all oil in the world is actually bought in US dollars. So this means that the price of oil has great effects on the US dollar, practically because a lower price means less demand for the US dollars, causing its value to decrease. Important to think about too is the fact that a lot of currencies are also correlated to the US dollar, but more about that later. So the second point is what we have just talked about. Some countries' economies are really dependent on the price of oil. So this can be like the case of Russia we just talked about, but there are also countries who import a lot of their oil, like Japan, and they actually suffer when the price of oil rises. And the last reason for the big correlation is that oil itself is correlated with a lot of other industrial commodities like plastics. So this means that oil also has effect on other industries in all countries, and that is definitely something to think about when trading a certain currency. You can ask yourself the question, do they produce a lot of goods that need oil? And last of all, I want you to realize that you need to always think about currency correlations. As I said with the US dollar example, the price of oil might change the price of a certain Forex pair, but these Forex pairs themselves might in turn also influence other pairs they are correlated with. So now let's get back to the cheat sheet again of oil correlations. So if you haven't done it already, you can now make a screenshot of it, and hopefully you understand some of these correlations a little bit more. But now I'm actually going to explain them individually. So first of all, we have the oil price when it goes up, then the US dollar against the Canadian dollar goes down. And this is for the simple fact that the US dollar imports a lot of their oil, around 51%, and most of this oil is imported from Canada. So when the oil price goes up, Canada receives more money from their oil from the United States, and therefore this currency pair goes down because one United States dollar actually is worth less Canadian dollar because there's more demand in Canadian dollars. And then the next correlation is when the oil price goes up, then the US dollar goes down. And that is a little bit the same as the Japan example we talked about. I just told you that the US dollar is a net importer of oil, so they import a lot of oil. which means that if the oil price goes up, they basically have to pay more for the oil, and that is bad for the US dollar. Then we also have the positive correlation between the oil price and the Russian currency, the Russian ruble. This is basically because Russia produces and sells a lot of oil, so when the price goes up, they receive more for their oil. And here it is, I think, important to remember that you should always take a look at currency correlations too, because you might not trade the Russian ruble, or perhaps I think not a lot of people trade it, but the Russian ruble is correlated to some very tradable currencies, and that's something you always need to look out for. And then lastly, we have the positive correlation between the oil price and the Canadian dollar against the Japanese yen. And this is for two reasons. First of all, Canada exports a lot of oil, so the price goes up, they receive more money for their oil. And the second reason being is that Japan imports a lot of their oil, so when the price goes up, they actually have to pay more for their oil, and then this Forex pair goes up. So with that, we have reached the end of this video about oil correlations. If you have any questions about this video, I want it to be as clear as possible, but still, if you have any questions about the correlations or maybe some follow-up questions, make sure to ask them in the comments. And then thank you for listening and watching, and I hope to see you in the next video. Bye.